So welcome on back into the program. On this segment, we're going to talk a little bit about investment returns versus investor returns, right? They sound like they're kind of the same thing, but the reality is they're actually quite different, particularly when you start to look at what those numbers mean. So here's an interesting statistic, courtesy of the folks at Fidelity. If you look at the S&P 500, they measure this as of June 30th. So the S&P 500, a trailing one-year return, so year-over-year return as of June 30th of this year, S&P 500 was up a little over 24%. Yet, the average IRA account balance grew by only 14%. And for larger IRA accounts, balances in excess of $1 million, they only grew by 6%. So what's going on with that? What is the reason that investors are not getting all of the investment returns that they should be getting? So we're going to talk about that on this segment here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also, one of the top 25 financial planning podcasts. So make sure you check us out over on our website at Nelson Financial Planning if you're looking to connect with us directly on any of our channels, on any of those platforms. My name is Joel Garris, Certified Financial Fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be Certified Financial Fiduciaries as well, that stand ready, willing, and able to help you improve your life with a successful and cost-effective financial plan. So let's set the stage for this conversation by really drawing the difference between investment returns versus investor return. So an investment return is what we see sort of all the time. That's what people talk about. It's what gets quoted. It's what gets referenced, because that's the available public data, right? So if you've got a fund or a stock or whatever the case may be, then we all know how to sort of calculate the investment returns on that particular investment over a specified period of time. And so when you think of it, that's what you need to understand about investment returns, is that investment returns are reported as if you bought at the beginning of that measurement period. So if the investment return over a 3-year period of time is X, then it's looking at, okay, go back 3 years. That's the start date, if you will, all the way to the end date. That's the measurement period. Also, the assumption when you look at investment returns is that you are going to be reinvesting all of the income, all the interest, all the dividends, all the capital gains that comes from that particular investment. That's a key part of investment returns, because historically dividends, for example, have contributed over 40% or nearly 40% of the performance of the overall market over the past 100 years. So you can see where, wait a minute, that reinvestment piece, that's a big part of this definition of what it means to have a particular investment return. And then lastly, you never cashed it out. You didn't move out of it and back in, or whatever the case may be. So understand those three components. There's a specific period of time, a measurement period, in order to that investment return covers. There's the assumption that all of the dividends, all the interest, all the capital gains winds up getting reinvested, and then that you actually own the investment for the entire measurement period, meaning you never cashed out. So I guess that's the key piece. Out of all of that, those three parts of that definition of what an investment return is, the key piece is the never cashed out part, right? So, and that's probably the biggest reason why investor returns, what someone actually gets when they're owning a particular investment, in fact, never actually really matches the actual investment return of the particular investment, because investor returns, well, now you're introducing those tricky little humans into the mix, and actual human behavior involves things like taking money out of investments, moving money around, all kinds of things. The reality is that if you think back to that statistic we gave from Fidelity, it's pretty dramatic, though, the gulf. It's not just a little mistake here, a little mistake there. The reality is that when we talk about investor returns only being about 60% of investment returns, that's a problem. And we certainly can understand that, right? There's a lot of ways to get distracted. Did we mention there's an election coming up in a couple of weeks? That may be a chief distraction that's going on right now. But all of this data sort of connects back to some of the performance gap data that we shared on a prior show, I think probably about a month or so ago, about the latest Morningstar Mind the Gap study. Showed that for the 10 years ending December 31, 2023, investors as a whole earned about 1.1% less in terms of the performance, investor performance relative to investment performance. So 1.1, that doesn't necessarily sound like much, but if that's per year for a 10-year period of time. So cumulatively, that winds up being, more like 13, 14, maybe even 15% if you kind of run the math on that and put the power of compounding in that. So that's a pretty significant gap. For sector funds, so funds that look specifically at a particular sector, maybe it's financial services, maybe it's technology, maybe it's consumer staples, whatever it is, that gap actually is even greater. So investor returns fall short of investment returns by about almost 3%, 2.9% per year over a 10-year period of time. Well, that's almost a 40% differential, which sort of measures up or matches up with kind of that statistic that we were sharing earlier in this segment that was from the research that the folks at Fidelity did. So what can you do, right? What can you do with all of that? How can you narrow that gap between your investor performance, your personal performance, if you will, and the actual investment performance of the funds or investments or stocks that you own? Well, three things sort of come to mind, if you will. Number one is you probably want to stick with the broadest possible allocation. If you think back to those statistics we were sharing about the gap involving sector funds being 3 times as much as the gap just in broad-based diversified types of investments, well, then that'll give you at least an indication of maybe I just want to stay away from the sector stuff altogether and get a little bit closer to what the actual investment return might be. Number two, don't overreact to the headlines, right? Jumping in, jumping out is probably the biggest factor that undermines your results. I think there's a key concept here. The news is not interested in being right. The news is only interested in being heard. Stop and think about that distinction for just a little bit. And if you're letting the news or the headlines or whatever it is that you read out there on the internet ultimately drive the decisions that you make with your investments, then you're going to just widen that gap between your investor return and ultimately what the investment return actually is. And then lastly, seek professional advice and counseling. Some of the biggest roles that we serve at Nelson Financial Planning is to provide that perspective. So whether you're using our firm or whether you have someone else that is helping to provide some advice and guidance, the bottom line is they should be helping to bring some perspective to what's going on out there on a regular basis, and that perspective really does help to maintain that consistency that you need in order to bridge this gap that occurs between investor performance and investment performance. So make sure you're working hard to bridge that gap, because That's the only way to achieve the best possible investment results. With that, we're going to wrap it on up and get on out of here. Thank you for listening to the program. If you're interested in learning more about who we are at Nelson Financial Planning or taking advantage of our absolutely free consultations, we don't have account minimum, so come as you are, if you will. Wherever you are on your financial journey, we are here to help. That's one of the biggest reasons why we don't have account minimums. So to get connected, just go to our website, nelsonfinancialplanning.com. Have a great rest of your day. Thanks for listening to this week's program.